Good morning and welcome to the Monday Market Update, brought to you live here from frigid, cold, icy, snowy North Texas. And how's the weather there in Florida, Andrew?
Well, we were in the 70s all weekend up until this morning, and we are now in the 30s, and we'll be wind chill of 12 degrees here tomorrow morning. So we are going to not have ice and snow, but we are going to be cold.
Yeah, I think we were feeling like 5 earlier, and we got lots of snow, lots of ice on the ground. Everyone's been stuck inside their homes for the last 3 days. Kids aren't mad about it. They're out of school today and tomorrow, so it's it's a good time to bust out those sleds that we buy for like once every 4 years here in the North Texas area. But
we don't have sleds. We just use our boogie boards from the beach to go sledding. That was what we did. We had like 7 inches of snow here last January, and everybody was sledding on surfboards and boogie boards.
Oh, y'all are prepared then. We are not. We got those garbage pail lids and things here, and strips of laminate flooring. I saw kids taking and turning into snowboards, but they're having fun. Everyone's having fun because they're not paying attention to markets right now, and that's why they can be carefree while we are here not feeling so carefree. So let's get into what's been going on here. Talk about the news in last week. So, what looks like a Met volatility started at 621, finished at 619. There's a little bit more to the story than that. So how are you giving us this Met analysis?
Oh, I mean, this is looking at last week's. I mean, really, because we missed last Monday due to whatever day it was, some holiday. There was a lot of volatility the week before that. But yeah, I mean, the markets have been unstable, lots of swings, but overall movement, not much. And unfortunately, kind of back to this 6.2 that is as sticky as Gorilla Glue at this point.
Yeah, I mean, the volatility is a lot of time been intraday. We're seeing things go up and down and move around a lot and then get back. And by the end of the week, we're right back where we began. So yeah, the week prior, everything all over the place and not a lot to do with econ data. So let's talk about the data and where things are going here. So it looks like a heavy week last week. It should have been a very heavy week last week. In fact, markets should have cared very much. They did not. They didn't care at all. Anything that stands out to you on last week's econ data that you want to get back into?
I mean, again, the markets don't care. I mean, we could literally just open this meeting and say there was a lot of news, the markets didn't give about it, and that's basically where we're at. I mean, Trump's speech on Wednesday should have rocked markets. Had a big impact. Following day rebounded right back. Core PCE, that one was there should have been market moving data, but really it's also worthy of noting we stayed somewhat range bound in mortgage-backed securities more than the 10-year Treasury did. 10-year Treasury had a pretty volatile week. Mortgage-backed securities, we had some intraday movement, but overall didn't really kill mortgage rates too bad.
Yeah, no, that was weird. We lost the 10-year bond over through, the top end of that comfort. We get all this good info, like all the core PC, and I guess, to be fair, it did all come in that range. Nothing that should have been a surprise there, but that range is fairly surprising. GDP smashed it, but Nothing mattered. All that hit last week was news. Are we buying Greenland? Is Greenland mad? Is the EU going to sell off a bunch of Treasury bonds and send our bond yields up? Like, that was fun. I'm like, cool. All right, sell our stuff. But last week's economic news could be better summed up in a couple of Truth Social points. But what about getting into this week? It's Fed week, so surely something exciting, something big, something we can look forward to. Actual movement.
We'll see. We'll see. I mean, yes. I mean, the Fed, obviously, they meet. We're going to get our Fed rate decision on Wednesday. Expectation is for it to not move. Markets are not predicting a move. So I would agree with that. Fed's not going to make a move on this. The speech after the meeting could be extremely volatile because there has been a lot that has changed since the last Fed meeting with, a Department of Justice investigation, pressure from former Fed insiders for the Fed to nominate their own temporary chair. There could be fireworks at this meeting, or it could be business as normal. Either way it goes, I think we could be in for a wild ride in markets, or markets could just continue their I don't care mentality.
Either super wild or not caring. That is, you're really covering the 99% there on all that. Like, yeah, I'll take the over 35, but I'd also like the under 34. Okay. Not leaving a lot of room to be wrong. I like Andrew's style. I am in somewhat agreement here. I think the Fed decision obviously is not going anywhere. What they say afterwards is going to be really significant. I don't think we're going to see we haven't heard more chatter about the Fed nominating their own chair. So I think if that was any bit of a likelihood, we would have heard a little bit more about it than
Agreed.
A few people recommending it. So I'm expecting it to be a pretty big nothing burger with cheese until we get some tweets and send things into a spiral from there. Let's talk about what the Fed looks like so far going forward for the rest of the year here. This non-move in January has been telegraphed effectively 97%. It ain't moving. So that should hold steady through the rest of first quarter. And, for a while now, we've gone back and forth between when's the first rate cut. Is it going to be April? Is it going to be June? June looks like a pretty solid choice right now, which is good. The fact that these have moved back a little bit, it's not a bad thing. Having a more balanced year is good. So, one drop in June, another one had been October. As soon as September. Now we're showing October pretty solidly. Cool. But there's not a lot of all over the place on this. Everything is pretty chill. And I do find it interesting that as you get into the 2027 data, that's when you start going to that rollback, that roll up, where, a lot of people's targets for, the Fed funds rate goes back to that 350 mark instead of that 325.
Correct.
Good ad, Andrew. Thank you.
Yeah,
I know it's right.
I mean, you're right. I mean, you said all the points that need to be said on this. I mean, listen, there's still a 2.77% investor chance that we're going to get a rate cut on Wednesday. Okay. Like I'm not taking any odds on that, but I question who these investors are. Like, how out of touch with the markets are you that you actually are one of the defectors saying, nah, I'm going to go against the 97.2. But nonetheless, I think we're very well telegraphed for a June as our first cut. Obviously, data will drive that. We will be a lot clearer when we have the March meeting of what that looks like, because there's going to be a lot more data that comes out in the interim. Where the second cut falls, I think that's absolutely a wild card. Could be July, could be December. And until data hits, first cut hits, reaction from first cut hits, investors are way speculative on that.
Yeah, no, you're right. And that's kind of what I was hoping to hear from you. I do think that we could see the need for that first cut coming up sooner. I think we could get back to that end of April timeline, just because there is a lot of data, like you said. The data has been supporting things moving in direction that would favor a cut, and markets like to overreact both directions. So if we start building some momentum that way, next thing you know, we had a couple early cuts earlier last year. I'm like, we could see, we can jump in a little bit. But all that to say, this week is not cutting, but we're going to hear what they say and go from there. All right. Where
mortgage rates?
Yeah, it's ugly. It's been so pretty for a while. But
yeah, I mean, we're just holding this. We're holding the 6.2 level that we found. right leading up to the very first Fed rate cut. I mean, you see those drop downs starting right after September 2025. That was the drop down before the first Fed rate cut. But really right before that was about 6.25. We're about 6.2. And we're just, like I said, this is as sticky as Gorilla Glue. And I think this is a good point to bring up on this slide. If you're a real estate professional or you're a mortgage lender, this is why posting interest rates on social media can be so scary unless you're truly following what the markets are doing. You know, you could be posting saying interest rates are hitting. I literally see news articles hitting my desk all the time that say interest rates at a 52-week low or whatever the number is, 22-week low. And I'm like, yeah, that was 4 days ago. Unfortunately, the markets have completely flipped on their head. And so you got to be super in tune with the markets, following updates like this. Or if you're a real estate agent watching this, following loan originators that you trust actually have relevant and accurate data, because the market moves often. And when it moves, it tends to move quick.
And I would counter that with, when it moves, it's not moving more significantly that someone who was going to get excited about 52-week lows shouldn't be now just because we're off those lows.
Agreed,
so,
100%.
You know, whatever you can get in front of your audience with, and you've got good information from trusted professionals, that's going to help. Andrew, why did we have that weird little smiley face glitch? And I see the last couple drops, the last little three. I know that those all came before the last few Fed meetings where we dropped, pop back up, drop, pop back up. What about this last drop? What caused that? If I didn't know,
that was Trump's announcement of Fannie Mae, Freddie Mac purchasing mortgage-backed securities to the tune of $200 billion. Now, news did come out, broke out this morning, that Fannie Mae and Freddie Mac have been capped at purchasing or holding onto their books a cap of $40 billion. And to purchase $200 billion, something's got to change. Well, news is out as of this morning that they have increased their cap. Did they increase it to $200 billion? Nope. They increased it to $450 billion, which opens the door for them to exceed the initial $200 billion that has been talked about. Is that going to react into markets? Potentially, but I don't think markets are going to speculate on that. I think we actually need to see that first $200 billion be purchased. I think that, drop down two-tooth smiley face we see on the screen there, that was in anticipation of it happening. When it actually happens, will rates come back down closer to that 6% mark? I think there's a strong likelihood they could. I think the markets got excited about it. The excitement wore off. But it does appear that we're actually setting ourselves up that this purchase is going to happen by extending the cap from 40 billion to 450 billion.
Yeah, I think the markets got excited, rightfully so. And, there's always a small pullback from the initial excitement load. But I mean, honestly, that shot up. It doesn't have anything to do with waning excitement. Everything to do with the 10-year Treasury bond going flying, crossing that 4.2 threshold, getting up to almost 4.3%. And again, that's because, administration said, oh, we have to have Greenland. Surely we're going to go get Greenland. And then, you get the threat of EU representatives, EU countries starting to sell off Treasury bonds from the United States. That threat causes bond prices to go down, yields to go up. And here we are. So, one tweet to drop them, one tweet to raise them back up. And, the truth is somewhere in the middle of all that. The bond buying will definitely have a favorable effect on, interest rates. Opening up to 450 billion to where we can buy mortgage-backed securities, that'd be amazing. But, my eyes are all on the 10-year Treasury right now, 4.20. I feel like that really needs to show that it has some more room to wiggle, some more room to move. We were holding these good numbers with a 412 to 414 bond price, but we're not going to get any meaningful impact unless we get this bond closer to 40 or even below it. So my eyes are on there. We'll see where that goes going forward, but no big reason to believe we're going to break through those thresholds anytime soon. I'm just glad we're off the highs at this point.
I would agree 100%. And I think for loan originators watching this, you got to look at ranges we're in right now when you're looking at obviously your clients should be the ones dictating whether you lock an interest rate or not. But if you're giving advice on it, look at the ranges we're in on a 10-year Treasury. And if 420 is the floor right now and we're approaching the floor, might be a good time to lock an interest rate in, because there's a greater chance of possibility of us bouncing off that floor than breaking through the floor. And when we get back up to the highs that we were close to 4.3, that might be a better time to settle down and see when the market, if you're going to give advice, settle down and see if we can come back down towards that floor of 4.2. I think you just have to look at what range we're in when you're giving advice and give that advice carefully, but ultimately let your clients be in the driver's seat.
Exactly. Yeah, we are very range bound right now. There's nothing that's telling us which way we're headed, with this sharp drop, sharp increase, all based on kind of fake and speculative information happening from a geopolitical scene. Hard to say. Nothing mattered on econ data in the last 2 weeks. So does it change this week? We'll figure it out. We'll come back next Monday to break it all down and see, do we have new advice? Are we back to being range bound on econ data? That would be awesome. But, we'll have to tune in and see what happens this week. Any other final thoughts, Andrew?
That's it, man. Have a good day.
Awesome. Take care, homie.